Well, let's get across the market open now. Kyle Rodder joining us from capital.com. Kyle, good to catch up with you again. Of course, all about the Fed early this morning. Cutting rates by 25 basis points as expected. What more do we hear from Jerome Powell?
Well, we heard a shift in his language that the markets were looking for about the balance of risks to the economy, effectively saying that clearly downside risks to the labour market have built now, and that warrants a greater focus on labour market stability and health in setting policy going forward. And that was sort of fleshed out by the three cuts, including this one implied in the dot plot for 2025 before the end of the year, released in the median dot. So the markets welcomed that, but there was a lot more to the story. And I think that's why there was such a mixed price reaction in markets that saw what was an initial rally on Wall Street before something of a sell-off. And then by the end of the session, pretty much the S&P 500 and the Nasdaq were just as they were before the start of the session. And then, in fact, the US dollar finished higher and gold finished lower, perhaps perversely enough.
Yeah, interesting. Just taking a look at those dot plots too. There was one dissenter, perhaps not surprisingly, the new member, Stephen Moran, who advocated for a 50 basis point cut.
Yes, and it doesn't take too much of a leap to suggest that the dot that was below 3% for 2025 was probably Myron as well. And I think that's one of the reasons why we saw actually a bit of a recovery off the lows of the session for Wall Street, is that there's the sense that effectively we're talking about a tale of two Feds. The Powell Fed that will exist for the next 8 months and in its current form roughly, and then a Fed that will be probably led by a de facto Trump voter in whoever it happens to be, whether it be Waller or Hassett, whoever, Walsh obviously being the other one. So the markets kind of looked at that and sort of said, I think, clearly there is a dovish bias coming through after May next year when Powell finishes up his tenure. On top of that, there is obviously an emphasis anyway from a majority of the FOMC to focus on the labour market rather than these upside risks to inflation. The dot plots suggested that the Fed once more will not be achieving its inflation mandate for at least another 2 years by its own forecasts. And all of that culminated in, yes, some rate cuts coming out of the market because the summary of economic projections only forecast one more cut in 2026, but a sense that there are effectively downside risks to rates because Myron and whoever comes in to replace Powell next year and Trump's selection for the board will probably be similarly dovish.
Now, as you mentioned, stocks actually coming off. We saw gold come off as well. The interest rates there, just in terms of what we saw on the bond market, round-tripped. The dollar, what did you make of that, the US dollar moves? Obviously, having hit sort of a 3-month low, where to now, do you think?
Well, I think the dollar gives us the best signal about what is actually happening in the rates markets, which is to say that before yesterday's decision, we had market participants already pricing in 3 cuts before the end of the year, and then subsequent cuts that would take the federal funds rate below neutral and down by probably a further 75 basis points through 2026. What we saw is effectively an indication that that is not the current trough rate predicted by the FOMC as it's currently composed. The direction of travel is a little bit shallower for rate cuts going forward. And as a result, the markets have had to discount the fact that there'll be fewer rate cuts based on the Fed's current projections than what was priced in yesterday into the rates curve. So that's why we saw that whippiness in yields, a bit of a bounce back in yields. We saw gold up above 3,700 again, very, very briefly, and then the dollar sell off briefly. It sent the euro above 119, sent the Aussie dollar well through the 67 handle, but that all got reversed again when it was sort of inferred that the trough rate next year will be a little bit lower than what the markets were pricing in. So equities kind of ignored it for the most part, and that's why we've seen sort of curious choppy price action, which actually took both, again, the S&P 500 and the Nasdaq pretty much to where they were before the Fed. You can pretty much write off those moves, but the dollar is telling us what is really going on in the rates market, which is to say fewer cuts that are being priced in today than they were yesterday.
And when you take a look at the equity market, obviously near those record highs, having priced in those rate cuts, where to now? What are equity investors going to be looking for, do you think?
I'm going to be really curious to see how the dust settles over the next 24 to 48 hours, because it wouldn't be the first time, if it did happen to occur, that equities are a little bit late to the party, and then over the next couple of days, post this Fed decision, start to discount a shallower rate cutting path and a slightly higher curve than before. And if that's the case, then that could put some downward pressure on equities. I think what's noteworthy, once again, is that we had very low volatility going into this event, very low implied volatility as a risk event going into this Fed decision. And although we saw some degree of chop around it this morning, there wasn't really the kind of typical volatility that you would see for an FOMC decision, suggesting that, again, there is this kind of calm, arguable complacency throughout the markets, one that often precedes, a fairly significant rug pull that could see, something of a risk-off environment prevail for a little while. Given the dynamics are the same, where sentiment has been very, very strong, again, there's that complacency there. Valuations are still looking rather rich. There's some fundamental risks out there to the growth in the US economy, and positioning is also very stretched as well. It still speaks to me of a market that is prone to some kind of a shock that could prompt effectively some kind of a drawdown in equity prices, if only in the short term, to blow off some of that froth. So the next couple of days, I think, could be interesting, notwithstanding that we've also got some risk events that could shake up global markets just a little bit outside the US. It could be interesting to see how the dust settles here, because at least on paper, markets that are discounting less rate cuts than they were, only 24 hours ago, should result in a little bit, even if only modest, re-rating in equity prices.
So, Kyle, the weaker US jobs market, obviously a catalyst there for that move by the Fed. Now, jobs also in focus here locally. We get the read for August. What's the expectation there?
Basically, we have a steady unemployment rate of 4.2% and a increase in jobs, which is, pretty much to offset the modest increase in participation, or at least the, supply of workers in the labour market. Obviously, the critical detail here at the moment for the RBA is to what extent the labour market is deteriorating against a backdrop where now inflation looks like it's largely under control and around that midpoint of 2% for in the target band. This will tell us whether the markets are right in sort of assuming that there's another rate cut to come and then that is it for a little while, or whether that rate cut may not even be justified before the end of the year, or whether markets need to start pricing in a much more aggressive rate cutting cycle, which has come out of the market a little bit by virtue of solid household activity data contained within GDP recently, also retail sales that we saw recently as well. All of those things that might kind of keep policy on hold. But overall, it's looking like a 4.2% number. It could inform that next RBA decision in a couple of weeks' time. It's unlikely that they'll cut at that meeting. But the market's still flirting with this idea of whether the RBA cuts again before the end of the year. And this could drive more or less the timing of when that next cut could arrive.